Hello. I'd like to take this opportunity to talk to you about the time value of money. The time value of money is actually a straightforward concept, but it's used all of the time in business. So if you know that, some of the benefits is when you're doing an investment analysis to decide the financial benefits of a project, to determine alternatives. This can be for the company itself to make decisions, or for personal investors. It can help a firm analyze how time impacts business activities such as loans, mortgages, lease, savings, annuities. So it helps us compare things and to be better able to understand what this time value of money is. If we look at it from a personal perspective, a personal investment perspective, the longer your money is invested, the more time you have to benefit from the powerful effects of compounding. And compounding, put very simply, occurs when any earnings on your investment are put back into the account so your money has the opportunity to grow. So it's income on the income. And that becomes a huge number over a period of time. The longer you stay invested and have the earnings automatically reinvested, you can have that powerful effect. Let's just take a little look at this. The easiest way of looking at this is that a dollar today, $10,000 today, if you look right here, that over time, at an interest rate of 10%, at the end of 1 year will be 11. Next year it'll be 12,001 because you're not computing the 10% on the 10,000 any longer, but on the 11,000. Okay? And then at the end of year 2, it's going to earn another 10% going into year 3, so it's 13.3. So what we see is that the interest on the interest starts to build up here. Okay? That's the future value of money. Now, if that is true, and we look at the opposite of that, $10,000 in the future is not worth $10,000 today, because if you could have the money today, you could invest it and make more. So when we look at this, 10,000 in the future equals 7,500 in the present value. So we have future value, and then we have present value. Now, all of these become important when you think about it. Putting a dollar today is worth more than a dollar in the future because it can be invested and earn interest. Value interest invested money will grow to become earning a specific rate of interest over a given period of time. The process of growing today's present value to a larger future value by applying compound interest is known as compounding. We then have the present value, okay? And that's the amount needed today to invest at a specific rate of interest over a given period of time to accumulate a desired future amount. Discounting is the reverse of compounding. Process of working from the future back to the premise. When we're compounding, we're going from the present to the future. With present value, we're discounting it or bringing it back. So, when we look at it, what are the key factors? These are the things you need to understand. These are the assumptions, if you will. So in every situation that we're looking at time value, it's the principal amount. How much money is the invested? It's either a lump sum payment or an annuity. Annuity is simply a stream of equal installments at equal time intervals. Yes, we can do them on variable, but at this point, all we need to work about is principal. It's either a lump sum or it's an annuity, a stream of equal installments. Number of periods, always number of periods. Interest rate, what's the annual percentage rate? So now we got to think, if we're looking at it on a monthly basis, we may have to present it on a monthly basis. So in interest rate, we have simple interest, and then we have compound interest. So these are the key factors that come in. Okay, what we're going to take a look now is some Excel worksheets, talking about some samples, some bond, and doing some stuff around internal rate of return. So the first thing is everything you need to know about time value of money. Every way we calculate, there's multiple ways. You can do it by hand, you can use tables, you can use calculators, but the easy is to simply use formulas. So if you click on your Excel bar that says formulas and you look at financial, you will see there's a whole pile of them there. That's a technical term, by the way. And what we can do is bring up the appropriate formula we need. So the key again is for you to understand what these assumptions are and be able to pick the right formula. This is again showing that example at 5%. If you start out with 10, multiplied by 5, that's 10,500. Next year it'll be the 5% on that, and so on and so forth. So now let's take a look at a couple of scenarios to say what is the future value. So let's take a look. Is that I assume that the interest rate is 5%. See, I put it right in up there. 3 years, because it's an annual time period, and that's the present amount. So then there's the formula. But let's bring up the formula. The formula starts with Now we're going to continue looking at our Excel worksheet, and this is one that'll be very valuable for you, both for your project, but more importantly for our quizzes. There will be questions on present and future value. So here it is again. How much will a sum be worth in the future given a specific interest rate? This is this example, this time chart again. And this is one way that you could figure it. You could keep going 10% and figuring it out that way. You could use a calculator. But the easiest and most efficient and accurate way is to use one of the formulas. And if we click on the formulas bar, we'll see financial comes up, and there are a number of financial functions. The key in finance is to know which financial function you need to. Let's take a look at what, if we're comparing, we have 10,000 today, and we can invest at either 5 or 8% over 3 years. And we have 10,000 today. Using a formula, comes up. So what do? We want to look at a future value. So we go to financial, bring up future value, and as you can see, first question it asks you is a rate. Now remember, this is annual. This is annual rate per period. So we're going to put that one in. Then the time period is 3. Then we're going to put in the present value, and you put that in as a minus, and there's our 10, and $640,000. Okay, so now I've shown you these formulas here. I've built them, but now let's see how they work. So we go up here to financial, and we want a future value. So you come down, click on future value. What do we know? The rate. Okay, put that in. Number of payments, 3. How many payments are there going to be? There's only going to be up front. Okay, it's already there. So we put 0. Present value, what it is today, we put in as a minus 10. And as you can see, it comes out to $11,576.25. So that's what you want to do. You want to go to the financial function, and in this case, bring up that. And again, the rate, we know there's the rate. NPR, number of payments. But the payment is all up front, so you put 0. If it was $10,000 a year, that would make it into an annuity. Then we put in the present value in the negative, and that comes out to $12,597. So now, one of the things I wanted to show you is that if you go monthly, okay, we're going to have compound month interest monthly instead of annually. We do the same thing. We bring up the future value. The rate isn't just 5, it's 5% divided by, since it's money, monthly, 12. And then we have 36. Again, the payment is up front, and we put a minus in, and we see that it's $11,614.72. So the difference between these two is the impact of monthly compounding. So what you should be able to do is think about questions that when they come up, how much will you have given this? Knowing the formula in what these different pieces. So go back, bring these down, play with them. Make sure you know how they work. Next thing is present value. How much is a sum in the future worth today? Okay, so again, this is taking it where here we went forward. We want to find out what that is. So the first thing we're going to do is we're going to use a formula. Okay, and this time we want to know present value. Okay, so we're going down. Oops. And there's present value. And again, a formula comes back up. And again, we put 5. Periods are 3. And if we read, is the payment made each period? It's 0. The future value is going to be 10. So it's $8,482.13. Okay, so what we're doing here is we're using, so now what we're going to do is we're going to bring in another financial formula. This time we're looking for present value, PV. So we put PV in, and again, it's coming back with what are the function arguments. So we put in the rate, 5%, number of periods, 3, payment all up front. That's what's going to be at the end of 3 years. So we'll put 0 because it's a lump sum, not an annuity. And the future value, we know we want to have $10,000. So when we put it in, what we find is that $10,000, if I can invest my money for 3 years at 5% annually, at the end of 3 years, I'll have $8,000. The present value of that is $8,638.38. Now, when we do this way, in this case, it's the opposite of what happens. The higher the interest rate, the lower the present value is. Same thing when we get to monthly, we need to make sure that the arguments that go in all of these reflect, if we bring up present value again, we can see that we need to make sure we understand them. So these are single payments, okay? So when we get into single payments, that's called single payment, lump sum. Then we can move into annuities, which are more than one payment. So in this case, we are investing $10,000 every year. And our question is, how much would we have in 3 years? So in this case, what we're going to do is we're going to go to the future value again, then future value. So we're going to bring it up. The arguments that we're going to put in are different. So we still got 5%. Number of payments, 3. The payment each year, because we're going to put $10,000 in each year. And the, put the negative, it's got to go in as a negative. There you go. And there you go, 31,000. So again, it's knowing where to put the numbers. Same thing monthly. So then we can work backwards again. We can use future or present value. Okay, we come to present value and we can put in the rate. Okay, and we're going to put in the number 3. And the payments are going to be $10,000 each. And we see that's going to go. This is where you got to check your work carefully. Okay. I was putting the future value together, so we just take that out, find the correction. The number wasn't right, so 27,232. So we use that formula when we want to come out. So just to summarize this piece here, what are the things you should know? You should know how to use future value, present value. And when you're doing this, let me just go highlight this for you. You do that in red because it's important. You need to be able to know future value, present value, interpret that. Okay? Now we move on to determining a payment amount. And guess what? There's a formula for that. Okay, so again, we're going to go over to formulas, financial, and what we're going to look for is payment, PMT. Look at that. You got one. And it brings it up again. What's the rate? The period. Okay, number of periods, 5 years. Okay, and we're borrowing. It's the present value. Okay, so we're going to put in minus. And each year you would need to make a payment of $2,504.56. We can break it down monthly. We can use different periods. And we can see the time value, the impact of compounding. The last one you need to know is the internal rate of return. This is actually one of the most useful ones that we have to be able to compare and rank things. So I'll make this just a little bigger for you. And internal rate of return is the discount rate that forces the net present value of the total cash flow to zero. So it's what is the rate of return a series of cash flows generate. That can be used for comparing cash flows, and it's used extensively in capital budgeting and leasing. And when you do this, at least one number has to be negative, reflecting a cash outflow initially. So if we're buying two pieces of equipment, one is going to have, if you look here, we got a cash flow. Machine may cost us 15. This one is going to cost us 20, and this is the cash flow, the free cash flow that comes back as a result of that. So we put that in, okay, and when you have that there, guess what? There's a formula right up here. So what we're going to do is we're going to insert, you got it, a formula. And what formula might we use? IRR, internal rate of return. And this one is only asking you what's the range. So I just put in boom, 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 and the rate of return is 30%. So if you're thinking about this, go back and think about what a budgeting project may be. It may ask you to, I got these different options. Which one is better? Now let me just make a change on the numbers here. In this case, even though it looks like it can produce more initially, it doesn't have the same rate of return. So it gives us the opportunity to compare and contrast. Key formulas. What do you need to do again? You got to determine, is it future or present value? What's the compounding period? How many periods are involved, annual or monthly? Is it one or series? These are the things you need to know, how to use them. And the formulas, including the internal rate of return, they are all up here under formulas. Your key is being able to interpret them. Let's take a little example so that it can make some sense for you. And let's just take a look at these. They're on the next page here. If you save X dollars a month over Y months and an interest rate of Z, how much will I have? So at that point, you assume an interest rate of 5%. I put that in at, divide it out, it's a formula, because it's monthly, 240 months, amount per month, I'm going to put $100. So after 240 months, or 20 years, I'm going to have $41,000. Now let's just say I save 200, I'm going to have 82, but what happens if I save them for 360? I have more. And if I pick up a different 8% interest rate, I'm going to have even more. So it's based on all of these assumptions that we have. So that's an example. If you want $1 million when you retire, how much do you need to save each month? Here's my million. Here's my 5. And in this case, I'm using a payment because I want to determine a payment amount. Another example is you won the New York State Mega Millions, and you can take $12 million today or $1 million a year for 20 years. What should you do? Well, if my investment rate is 8%, okay, and I can get those payments over 20 years, and the payment is 1, the present value of those payments is 9818, the upfront payment would be 12. So in this case, I'm better off taking the lump sum. But now, let's assume the reinvestment rate is 4. At 4%, it's worth more. Again, time value of money comes into play. How much will your monthly payment be? If you borrow 25, 372, what are you going to do? You're going to use the formula, and it's going to be the payment amount. So again, you're going to take the rate, and since this is over 72 months, we're going to divide that rate. It's an annual rate, 12. The number of payments, 72. We're borrowing it all up front, so that's the cash going out. So we're going to bring in the payment amount, payment formula. There you go. The rate is 3, but since we're looking at it monthly, we would divide that by 12. And then we're going to look at the number of payments, 72. The present value, how much do we borrow? Cash out. And it's $379.84. Okay? Another example. How much is X dollars in the future worth today? Your grandmother wants to pay for the first year of college for your newborn and give you the money today. She remembers the time value of college, but asks you to figure out how much she needs to give you today to pay for it. So say it's $50,000. Let's put in 75 because that's more realistic, right? In 18 years, if the interest rate is 5, then over 216 months, that's how old it is. That's how old before they'll need it. And we figure it out using the present value formula. She needs to give you $30,000. So that gives us a sample. What we're going to do is this section here we're not going to get into right now. We'll look at that under in the future when we get to interest rates. So if you have any, I would play with these formulas. Everything is here. The key is knowing what assumptions and what the input arguments are. If you have any questions, please let me know.